Hey there, and welcome back to our channel. Today we're diving into a topic that can seem a little intimidating at first: insurance policies. Don't worry. By the end of this video, you'll understand the basics of negotiating and issuing insurance policies, plus some key legal principles you should know. So grab a coffee, sit back, and let's get started. First things first, what is an insurance policy? It's essentially a contract where one party, the insurer, promises to compensate another, the insured, for losses caused by unexpected events. In other words, it's an agreement that provides financial protection. Now, when we talk about an insurance policy, we're also referring to the written document that includes the policy form, optional provisions, and any riders or endorsements. A rider, by the way, is like an add-on to the policy. It can expand your coverage, but it might also limit it in high-risk situations. And don't forget, the application you fill out is part of the insurance contract too. Insurance is built on trust, what we call utmost good faith. This means both you and the insurer must be completely honest. As a policyholder, you're expected to provide accurate information about your situation, and the insurer promises to pay claims as agreed. If either party hides or misrepresents facts, it could lead to serious consequences. This is where concepts like warranties, representations, and concealment come in. Let's break these down. A warranty is a guaranteed statement of truth that becomes part of the contract. If it's false, the insurer can void the agreement. Warranties are more common in property and casualty insurance. A representation, on the other hand, is a statement you believe to be true when you apply for insurance. It doesn't have to be perfect, but it should be accurate enough to help the insurer assess the risk. Concealment happens when someone withholds important facts. If this is done intentionally to defraud the insurer, the policy can be canceled. Even unintentional concealment can lead to contract rescission, meaning the policy is treated as if it never existed. Here's a common question. What's the difference between a void and a voidable contract? A void contract has no legal effect from the start, like if it involves something illegal. A voidable contract, on the other hand, is valid until one party decides to cancel it. For example, if a policyholder stops paying premiums, the insurer can choose to void the contract. Speaking of canceling, did you know you can voluntarily cancel your policy at any time? However, if you miss a premium payment, your policy will lapse after the grace period ends. Always keep an eye on those due dates. Fraud is no joke in the insurance world. It involves intentionally lying or making false claims to get money from the insurer. Most insurance companies have a limited time, usually 2 or 3 years, to uncover fraud. After that, contracts like life insurance become incontestable. Here's an important legal concept: the parole evidence rule. This means that only the written terms in the policy are enforceable. Verbal promises made before the contract was signed won't hold up in court. So if it's not in writing, it doesn't count. Finally, let's talk about waivers and estoppel. A waiver is when an insurer knowingly gives up a right, like ignoring a policy clause. Once waived, they can't enforce that clause later. Estoppel stops the insurer from denying a claim if they've made a promise or representation that influenced your decision. For example, if an agent tells you something that isn't in the contract, but you relied on that information, the insurer may have to honor it. And there you have it, a crash course on negotiating and issuing insurance policies. I hope this made things clearer and easier to understand. If you found this video helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe for more easy-to-follow guides on insurance and beyond. Thanks for watching, and I'll see you in the next video.